Hello, and welcome to JP Morgan's Making Sense. I'm Meridy Cleary from the FICC Market Structure and Liquidity Strategy team. Today's episode focuses on emerging market credit, which is navigating a very different landscape than even a few years ago, driven by inflows, a shifting investor base, and greater data availability. To discuss how these themes are shaping liquidity, I'm pleased to be joined by James Banghart, Global Head of EM Credit Trading at JP Morgan. James, thanks so much for being here.
Thanks, Meridy. Thanks for having me.
So, James, let's start with the backdrop here. With higher rates driving more inflows into fixed income, emerging markets have broadly benefited, alongside a growing set of international investors seeking local market exposure. At the same time, recent volatility events have tested liquidity in EM. So, focusing on emerging market credit trading, how has the Middle East conflict over the past 2 quarters impacted EM credit trading from your perspective, James?
Sure. I'd say for us, the sort of interesting thing has been you had the sort of the start of the kinetic side of the Iran war in end of February, and then you had a lot of issuance prior to that kicking off, and then you came into March, and there was post the war, there was basically no issuance in March. So you had very little issuance. You also had a sell-off in rates, which meant there was a lot more money coming into fixed income generally, which we saw across the board, and EM benefited from that as well, which meant there was just a lot of money around and there wasn't really anywhere for it to go because the issuance hadn't happened. So you had an initial movement spreads wider, but then that sort of ground back down just because the wall of money coming in has created a bit of an issue overall. The other thing that happened is we sort of looked at it in the first couple of weeks. You felt that the Middle East was really going to suffer from a credit perspective, and it never really played out. Actually, there was still a lot of money sort of trying to find home and sort of looking at the opportunities from the Middle East perspective, rather than looking at the risk side of things. And then the sort of other dynamic that's played through is that China's been sort of a large saver for a long time and a large exporter of capital. And given the lack of issuance from Chinese issuers in dollars, generally given the geopolitical realities of the ground and China's sort of de-emphasizing the dollar across the board, the ability for them to export into the Middle East has been sort of the one saving grace for them in terms of investing. But that stopped when the war kicked off in February. So China's been very quiet in terms of investing in the Middle East for the last few months. That's put a lot more pressure on the local markets in China as far as where does the money go. And I'd say the overwhelming thing is that rates being higher has driven more money into fixed income. That's created just a backlog of cash around.
Interesting. And I guess to your point, how has the EM credit investor base evolved over the last few years?
In EM credit, you have the real money investor base, which has been growing and been consistent through a number of years. And a lot of that's the JP Morgan MB index-based tracking investor base. Then there's been a growth of the hedge fund pods, which has been true for the last 2 or 3 years. That's obviously been true across all markets. That's created a dynamic where the pods tend to trade the same way. So they tend to exacerbates local moves. The bigger thing in EM that's been true for the last sort of 12 to 18 months has been there's been a growth in local markets. So, you've got the Middle East, which has had its own investor base, which has grown a lot, mainly because with oil prices where they were, there was a lot of money coming in and there wasn't a lot of, they were building cash over the last 10, 12 years. And so that money had to be invested, and they've been buying other EM countries. I think also as the de-dollarization happens, you do see from central banks a push to move out of treasuries into other assets. Particularly EM credit is one beneficiary of that. China obviously bought commodities and other things that were non-treasuries, but other central banks we've seen over time have been buying, increase their US dollar emerging credit exposure. I'd say the other thing is that EM investors, traditionally banks, have been 3 years in. They've actually extended it out over the last couple of years. Now they're sort of like 10 years in. So they're a general extension of that investor base, which creates its own sub-investor that's not been there before, which again creates this dynamic where there's just a lot more money around.
Mm-hmm. And I guess if we shift kind of more to execution trends, when it comes to the evolution of trading protocols in EM credit markets, portfolio trading comes up a lot. It's played a much bigger role over the past few years. Have you seen usage plateau, or do you think it will continue to pick up steam similar to what we're seeing in developed markets?
I think within EM, DM portfolio trading is definitely present in a large protocol that's being used. I think with EM, for us, I think here at JP Morgan, I think it's around 1% of our flows in the last 18 months. So when you look at it, it's still a relatively small part of our actual activity. It's growing. It's coming from a very small base, and it's definitely a bigger part. I think when we look at the use case for portfolio trading within EM credit, we see it mainly in index rebalancing. So end of month rebalancing flows. You see it as far as money flows coming in and out as well. What we don't see it is a real risk changing thing. We also see it in transition. So, funds going from either changing weightings in IG to go into EM or vice versa. But again, I think it will grow as part of our overall protocol, but I think it'll still remain a smaller part than it is in DM just by nature of the asset class.
Right. Definitely starting from a smaller base there. And I guess staying on trading protocols, to your point, that move risk quickly, ETFs, exchange traded funds, have also become a big part of the EM credit toolkit, right? They allow investors to take broad EM exposure when the underlying cash bonds are less liquid or harder to access. And we've seen usage continue to grow. How do you see ETF growth shape your market?
So for us, we use ETFs generally to hedge a lot. I mean, much more than we would have sort of 2 or 3 years ago. Traditionally, we would have used CDS indices. CDXEM is the main one in the EM, or you use crossover or high yield in the States. The challenge of that is you're trading basis. So in the end, you're basically buying protection or selling protection, depending which way you're going. But you're managing a bond portfolio against that, so you're running an inherent product basis. Whereas the ETFs are a good way to manage that because in the end, you're basically trading bonds. And particularly with rate vol being probably the one underlying or the main underlying characteristic that we've seen over the last 18 months, it's important to have a like-for-like hedge. So, in that sense, it's quite good from ETF. The thing with EM that's a bit more challenging is your liquidity of EMB is still versus the DM indices is still lower. So like the actual penetration rate is lower. But we still, as I say, for us, if I look at what our hedge breakdown looks like, we probably use ETF is probably 75% of our hedge now versus whereas it used to be 75% synthetics. It's becoming much more of a base case for our overall usage. It comes up and down depending on where rates are. Now with rates being a bit higher, we probably use synthetics a bit more because cash demand is much stronger with higher rates. But it gives you another way to hedge and a different way to hedge, which is quite useful.
ETFs continue to be a big theme. As we know, the new EU and UK bond transparency rules are now live. Obviously, a major topic here in Europe, December 2025 for the FCA, the UK rules, and March 2026 for the EU post-trade bond transparency rules. So obviously, these have significantly increased the availability and speed of information on sovereign and corporate bond trading activity. And one of the focus points is how this could impact EM credit trading. How do you see us using the data? How do you see synthesizing the significant increase in data? Do you think this will benefit EM trading?
Yeah, I think it's been interesting. So between Europe and the UK, we'll cover sovereigns, which in addition to corporates, which in the sovereign market in the EM, it's pretty transparent and it's pretty liquid. So the impact is probably negligible given the amount of electronification, the amount of inter-dealer broker penetration. Like all of that means transparency and price on sovereign space in particular is pretty fluid. And because it's liquid, the transparency doesn't matter as much as far as pricing. In the corporate market, it's different because you've got a much less liquid market where if you're quoting something 1 million by 1 million and someone comes in and they want to sell 10 million, if you have pure price transparency, it makes it very tough to do the 10 million print. So what we saw in Trace, when Trace was rolled out, the ticket sizes became smaller, the market became more fragmented, liquidity got worse. So there's a trade-off. So liquidity versus transparency, and what's the optimal? It's in the eye of the beholder, I guess, and where you fall in that continuum. It's still early days, as you say, for UK and Europe. I think we're sort of waiting to see how it plays out. Do you see a bit of movement in flows depending on where transparency is? So you may see flows into UK versus Europe because the reporting rules are different in the UK versus Europe. As we see in the US versus Trace, when we see some trades happen in US hours versus some trades that happen in Europe away from the Trace prints. So it remains to be seen how that'll be playing out. I think, when we get the data, as you say now, so we do see the data, it's so much information that comes through, the usability of that's still early stages. So we're sort of looking how we integrate that into our daily trading.
Definitely. And we're tracking that development as well. And it will take time for behavioral shifts to take shape, but definitely something that we're on top of. And I guess staying on how, the market continues to evolve, I guess if we shift from public markets more to the private side, another buzzword has been, of course, private credit. Have you seen a push to private lending in EM?
Yeah, which is a good question. So the private credit has been something that, like, certainly when the US and you're talking DM frameworks, it's for the last, I guess, 2 or 3 years, it's been a major focus point and really in the last 18 months, I'd say. The US market, we don't have the same dynamic in the EM because the US private credit is really a regulatory construct. You had basically the rollout post-GFC of GSIB and Basel III and all that made it much more expensive for banks to retain the risk in a lot of these private loans. Obviously, banks still do this. It's a core bread and butter process that banks do. But as the costs got much higher to hold on balance sheet, the push from banks was to push to move it off balance sheet or move it into a different market, which is then puts the birth of private credit. So private credit in the DM market's been growing since the GFC, and it's been growing obviously much quicker over the last 3 to 5 years, I'd say, and that probably will continue. In EM, we are still largely a bank-driven market. So if you go in any of these jurisdictions, it's still the banks are still probably the biggest overall lender into the corporate space. I think that will continue because there's no real onus from a regulatory or capital rules perspective yet. That may change over time. The biggest thing we see is that in each jurisdiction, or the interesting thing about EM is it's very different. So whether you're in India, you're in China, you're in Brazil, you're in Mexico, South Africa, like they're very different local markets in terms of why the local credit market exists, what form it exists in, and how. And all those trades are bespoke. So every trade is unique. Like, they're new term sheets or new structures, and everything's quite novel, which is quite interesting versus the US, which can be much more formulaic. But the evolution will be interesting to see how it plays through time. EM is still growing. I think on EM, the other thing we have is we have sovereigns that also borrow in the private market, generally in repo format, but it's another access to capital that otherwise they may not have. So it's a good sort of liquidity source for them that's different than the public bond market. It gives them more flexibility. But yeah, private credit, it's there. It's more fragmented in EM. It's much more local dependent. So every market's different. It's growing, but it's growing at a different pace.
James, thank you so much for joining us today. We've covered a lot of ground from how geopolitics can test liquidity to how new trading protocols, technology, and greater data availability are reshaping the EM credit landscape. Thank you so much for your time.
Thanks for having me, Meridy. Thank you.
To our listeners, please stay tuned for more FICC market structure content on this channel. And please reach out to your JP Morgan sales representative should you have any questions about what we discussed today. Thank you very much.
Thanks for listening to JP Morgan's Making Sense. If you've enjoyed this conversation, share your feedback by leaving a comment or review wherever you listen to podcasts. And be sure to follow our channel so you don't miss an episode. The views expressed in this podcast may not necessarily reflect the views of JP Morgan Chase & Co. and its affiliates, together JP Morgan, and do not constitute research or recommendation advice or an offer or a solicitation to buy or sell any security or financial instrument. They are not issued by research but are a solicitation under CFTC Rule 1.71. Referenced products and services in this podcast may not be suitable for you and may not be available in all jurisdictions. JP Morgan may make markets and trade as principal in securities and other asset classes and financial products that may have been discussed. The FICC market structure publications, or to one newsletters mentioned in this podcast are available for JP Morgan clients. Please contact your JP Morgan sales representative should you wish to receive them. For additional disclaimers and regulatory disclosures, please visit www.jpmorgan.com/disclosures. Copyright 2026 JP Morgan Chase & Co. All rights reserved.